Morning, everybody. My name is Jalen Carter. It is my pleasure to welcome you all back for another start to our fall webinar series at the Tulane Innovation Institute. We're excited today to chat with some of our local experts about venture capital funding basics. I'm pleased today to introduce to you all both Evan Nicoll and Patrick Hernandez. Evan Nicoll and Patrick Hernandez are co-founders and managing partners of 1834 Ventures, an early-stage venture capital fund based in New Orleans. Evan is a not once, not twice, but three-time Tulane graduate, adjunct professor, and an active leader in Louisiana's startup ecosystem, with a track record of backing alumni-founded companies and advising entrepreneurs. Patrick is a Wharton graduate with more than a decade of experience across private equity, venture capital, and entrepreneurship, having launched SSBCI-backed funds and co-founded a national consumer brand. Together, they lead 1834 Ventures, a $20 million fund investing in startups with Tulane in their DNA and building the next generation of high-growth companies in Louisiana. Thank you for joining us.
Good morning, everybody, and thank you so much for taking the time to be with us. Patrick and I are very excited to lead this webinar to talk about the venture capital funding basics. Before we dive in, though, I do have a little bit of an icebreaker so that we can break through this digital wall that is between us. And so Patrick and I, we are based here in New Orleans. Music is a way of life here in the city of New Orleans. With that in mind, I'd like all of you to share in the chat, perhaps a local musician or artist that's a favorite of yours, or perhaps that you've been listening to lately. So with that, I will start. I've been listening to a lot of Dr. John, and I think it's because I just recently watched The Princess and the Frog, and his music was featured in it. So I'll start. Go ahead and throw in the chat a favorite local musician. Two Biscotti, love it. Prez Hall, always great. Dirty Rotten Vipers. I can't say that I have come across them, Nicoll, but I'm going to have to check them out. Appreciate that, Jalen. I can firsthand attest that I've been to a couple of DJ Soul Sisters shows over at they changed their name recently, the Soul Power Show, though. Delfeo, love it. Taking the Bangas, amazing. Little Freddie King. Y'all, I love it. Thank you for taking a quick moment to break the digital ice with me. The last thing I will quickly say before we dive into the material is that this week we come to the 20th anniversary of Hurricane Katrina, and I would be remiss if we didn't take a moment to reflect on what this moment means for our community and for ourselves. It was the largest and most expensive disaster to strike in this country and surely in this region. We owe a debt of gratitude to the many names and to those invisible names who persevered in the face of adversity to rebuild our city. To choose to run into the fire instead of away from it takes a lot of courage, grit, determination, and a little bit of naivety for what they were all up against. So if you think about it, it's not all that dissimilar to what it takes to be a successful entrepreneur. So with that, Patrick and I would like to present with you part one of venture capital basics. So let's dive in, shall we, folks? All right. So we are 1834 Ventures, and we've got our contact information for Patrick and myself here. Feel free to reach out to us anytime. Brief overview on 1834 Ventures. As Jalen had mentioned, we are a $20 million fund, industry agnostic, SSBCI, State Small Credit Business Initiative. I know we have folks who kind of come from all part of the spectrum of the startup ecosystem. So we are an SSBCI-backed fund with our partners at Louisiana Economic Development. We invest in pre-seed through Series A startup companies, and we look for founders with Tulane in their DNA. So what that means, it could be student, faculty, staff, alumni, parent, could have gone through Innovation Institute programming like this, LePage Center of Entrepreneurship program in the business school. So it's a fairly wide net, but we do want to see that there is Tulane in the DNA. Our check sizes range from about 50,000 for pre-seed investments all the way through 1 million, depending on the stage, industry, market size, and a few other factors. So just add a little bit more color context to that. Pre-seed, we write checks around the 50,000 mark. In the seed stage, we aim for 250 to 500K, and then I mentioned before, up to Series A to $1 million checks. What we aim to do is leverage this vast Tulane network to both grow and retain top talent here in Louisiana, but we also want to attract businesses to the state. It's this dual retention and attraction strategy. So we aim to invest in companies that are here locally. Perhaps it could be intellectual property to be commercialized by the Innovation Institute. At the same time, looking at local founders, as well as there are 150,000 Tulane alumni all across the country. We want to be able to invest in those businesses, and if it makes sense for their business model, find a way to bring some part of their value chain here in New Orleans or Louisiana. A little bit about our team. Jalen had gone over both of our bios, but just to add a little bit more color and context to ourselves. Personally, I have 8 years of startup investment experience. I ran an angel syndicate to create special purpose vehicles to invest in startup companies that had Tulane in their DNA. I am, as Jalen mentioned, I won't go into it, but I was a alumni, staff, and faculty member at the university and in the community, part of the Greater New Orleans Inc. Next Gen Council, Youth Leadership Council, Tulane Club of New Orleans, because why not? And then just a little tidbit, I'm also a 610 Somber. Patrick has 10 years of startup and operational investment experience, having come from Allianz Capital Partners in New York, formerly led capital access efforts for a local entrepreneur support organization in Propeller. And in the community, Patrick has been involved in On Path Credit Union, the Bureau of Government Research, as well as the Willow School. So 1834, we made a couple of recent announcements with some of our initial portfolio companies. We are very proud to announce that we have made 2 investments in a company called Cabana and Orion Longevity. Cabana is a digital mental health care platform for military veterans that provide both digital and on-site support services. They are currently based in Annapolis, Maryland, but we are in the process of moving their headquarters right here to New Orleans. They actually just signed a lease about 2 weeks ago, so we are very excited to welcome them to our community. Orion Longevity is an AI-enabled smart mattress cover, and they use fluid dynamics to both increase or decrease the temperature of the bed depending on your personal biometrics. One quick note, we have 2 other investments that are to be announced very soon to join our portfolio, and we are very excited for what's to come. All right, a couple of objectives here. So just to, we've got about 20 slides in total that we're going to get to for the first, call it 25, 30 minutes. And then we're going to open it up to question and answers for all of you. With that in mind, please, make sure to throw any questions in the chat. We'd love to get to them. You can either throw it over the course of the webinar, at the end, whichever you prefer as things sort of bubble up for you. So our objectives. We're going to review, there's a couple of different types of capital structures that we're going to talk about just to sort of set a base. And then we're going to move into what some of the venture capital fundamentals are, what we look for as a VC when making investments. Then we'll help you identify whether or not venture capital aligns with your business goals in general. Spoiler alert, venture capital is not for every startup business. So we're going to help you identify whether or not VC does align with your particular business. And then to dovetail on that, we're going to also talk about some other alternative funding options in the event that VC might not be right for you. We'll talk about what some of those could be. All right, so diving in, just a quick refresher on equity and debt. Equity financing is the process of raising capital through the sale of shares and the ownership of a company. Companies raise money because they might have a short-term need to pay bills, or maybe they've got a long-term goal that require funds to invest in their growth. By selling shares, a company is effectively selling ownership in the company in return for cash. There is an exchange there. When you sell, when you're exchanging, you're giving up equity into your company, it comes with a trade-off. And so taking equity investment can come with involvement, oversight. There could be some reporting expectations that can include regular updates, maybe that's quarterly updates, seeking strategic guidance, and potentially as a VC, maybe we're taking on a board seat to become an investor in your company. On the flip side, there's debt. There can be certain, so debt in its most basic form is just borrowing money with a promise to repay, often on set terms. Though, unlike equity, debt does not entitle the capital provider to ownership in the company or anything more than what is outlined in your loan agreement or loan documents. There are a lot of different types of loans that exist, and they dictate certain repayment schedules, interest rates, but they all include some sort of schedule, unlike equity. And also, for-profit, nonprofit businesses can access debt. One quick note that there are certain instruments out there that are debt instruments, but might be a bit of a hybrid. So it could be an equity instrument that takes on the characteristics of a debt, perhaps like a convertible note, for instance. So there are some nuances there. Okay, so who are equity investors? Equity investors, we come in all shapes, sizes, and forms. It's not just VCs. Angels are often, well, before angels, you've got what I like to say is your friends, family, fools, and founders. Those are typically your very first checks into any company. Next, you've got your angel investors. Angels are often the next check afterwards into a startup, and they will invest their own money and typically are able to take higher risks. So before kind of moving over into angels versus venture capital funds, I just want to highlight a couple points. Angels, they are individuals investing their own money. Venture capital, it's pooled money from limited partners. So there's a nuance there that is very important to highlight and determine, because as a fund manager, we are representing not just Patrick and I's interest, but we have 30 investors in our fund right now. So we are also looking out for their best interest. So it's just a little added nuance to be able to recognize. And that means that we're responsible to our investors, and that shapes how and where we invest. In between, you'll find family offices, corporate VCs. They might invest both for financial returns, but also strategic alignment. So as a founder, you're likely to interact with several of these investor types over the course of your journey. So I'm going to pass it off to Patrick, who's now going to talk about what are venture capitalists actually looking for.
Thanks, Evan. As Evan mentioned, especially as we focus on venture capital funds, I think it is important to go a bit more into what the structure looks like, because as he said, that is going to dictate part of our strategy. So it starts with a fund creating a thesis or investment strategy. And that's really going to be what they go out, what we go out and tell our investors, this is what we're looking to do. That in turn means that that is what we need to do. If we state that we're looking for a specific industry, we have to stay within that. And you're going to see a wide variety across different venture funds of what their strategy might be. So that's an important thing to recognize before you approach anyone, or as you think of, is this a good fit for my business? So along those lines, the structure of the fund, which is a closed-end fund typically, meaning that our investors come to us and they say, we're going to invest this money. You have a fund life of 7 to 10 years from when that fund launched, and they expect their money back at the end of that fund life. So as you think about when are you able to provide liquidity or an exit for that fund, they in turn have to provide that liquidity for their investors. So timing can be really important and something to understand as you look at the fund expectations of a venture capital fund. Ultimately, this typically translates to as we look at investments, we're saying, is an exit feasible within 5 to 7 years? Are you going to be able to sell that company, to IPO that company, to somehow have an exit event that brings the money back to us and ultimately our investors?
And one quick
And
thing oh, go ahead, Patrick.
and when you do have that exit, we're also going to be evaluating on the front end of when that time comes, does this company have the ability to reach such a point of growth that you might be able to return the fund? That's the trade-off of us investing in a really risky early stage business, and that's going to be pretty common across VCs. Go ahead, Evan.
Yeah. So, and another, just to hammer home that point, as a VC, we're looking at, is our $200,000 check that we write, is that going to have, if we have a $10 million fund, is that going to give us a 50x return? So again, just to kind of hammer home that point. And one last thing that I'll sort of underscore is the second that you take venture money, the clock starts. So as Patrick mentioned, as a VC, we're looking to exit our investment in a 5 to 7 year time frame. That's also within the 7 to 10 year of our fund life. So just again, at the outset, always know that if you are taking venture fund, or if you're in a position to take venture funds, the clock starts.
Yeah, absolutely. So that's just what a fund is inherently going to be looking at in terms of making sure that your opportunity fits within the parameters of their specific fund. But that's just the beginning. They're also going to be looking at whether you sit within a market that makes sense for venture generally. Um, and so, with that, some market characteristics that we're all going to be looking for. First is a large addressable market, and there are a few ways to determine if your market is addressable. First, is your company addressing a real problem? Um, Ultimately, if you are going to be able to capture market share, there needs to be enough people that are willing to pay for that, and that means that if it's not a real problem, it's going to limit your total market. And secondly, not only have you identified that problem that is real, but does your solution help? Is it a viable solution? That is all going to play into the scope that we look at whenever we say is the market that you're working within large enough? Um, Secondly, some factors include uh, the sector that you're in. Is it rapidly growing? Is it an emerging sector? Is there a lot more opportunity for that market to expand? Because whenever we look at large addressable markets, it's typically way larger than you're actually going to capture the market share of. But we then start to focus in on smaller and smaller portions of really where you're going to be playing. And so as we look at that, uh, you know, are you going to be able to play in an area that's new within that market? I.e., is it growing? Is it emerging? Because ultimately, capturing new market share, solving a new problem is going to be a lot easier for you to increase your revenue, get new customers, than it would be if you're simply stealing away customers from a competitor who's too similar to your own company. All of this is certainly um, uh, you know it can be done without being a pure tech company, but at the same time, looking at industries, at markets that are conducive to tech-enabled solutions are going to help you achieve that scale and that scale quickly that really we're all going to be looking for. So to give a few kind of finer points on what is a large addressable market, how do we think about that? Really, we're looking for anything over 1 billion, because that's not what you're going to capture necessarily. That is just what is out there. And so you need to start with a really big addressable market because what you're going to capture is going to be a fraction of that. Depending on really where you're playing, it's going to vary. You might have something upwards of 10 billion in terms of your addressable market. But ultimately, what we want to see is not only that number being large, but that you've thought about it, and that you have put real consideration into how you're defining that, as well as how you're defining some of your more finer markets, including your serviceable addressable market.
I would also just add that we are, whatever your TAM, your whole TAM SAM, we're going to back check that. So we want to know how you came to that number, how you arrived at it. But then we're also going to do research on our own to make sure that we feel like it's that it's congruent.
All right. So now that we start to look further at your specific business rather than just the market that you're working within, we're going to dig deep into some specific things about your business model. The first being what your gross margins. Are they high? Or depending on how early stage you are, do you have a pathway to getting to high gross margins? We recognize that when you're first starting out, there are not always great economies of scale. You might have some higher expenses, but there needs to be a clear opportunity for bringing those gross margins up. A lot of that is going to, again, play into the industry that you're working within. What is achievable within that, and how are you comparing in your projections to other industry players? The way to get better gross margins is to have a scalable business. You need to be able to increase your revenue at a rate that's higher than the rate at which your expenses would increase to support that revenue. So ultimately, we want to see not necessarily a hockey stick, because on your charts, hockey sticks are a really great sign that you haven't given meaningful thought to your projections. We want to see both a chart that seems realistic, aggressive, but realistic, and we also want to see the back end supporting of that. Ultimately, we do want to see that same direction, but really, we're not expecting you to go from low revenue to $1 million in revenue tomorrow. We want to ultimately see that you have all of these characteristics in your business model, but that you've been realistic about how you can achieve them. One of those ways is showing that your revenue is going to be either recurring or predictable. That gives a lot of comfort in that, if you have a product or a service that is going to need to be re-upped, whether it's on a monthly basis or a yearly basis, that means that you can reasonably predict that at least a certain portion of your customers are going to be repeat customers. You're not having to go out and obtain a new customer for every single sale. That lowers your costs and ultimately is going to improve your margins. And then finally, really understanding how you have defensibility against potential competitors. That can come in a lot of different ways. It can be through intellectual property, something that is quite literally protected by the government, and you have legal protection through a patent. And it could be that even if it's not patentable, that you have other moats around what you're doing. Maybe you got there first, and if you capture enough market share before competitors come in, the opportunity cost of switching is just too high for those customers, or they don't want to. There are a lot of different ways to show defensibility, but ultimately for you to having that. All right, so here is a breakdown of some different investment stages, and this is a chart that I always like to show, but also like to caveat that venture is notorious for calling the same thing different names depending on who you're talking to. So anytime you see pre-seed, seed, these aren't going to be hard and fast rules as to where you might fit in. The total amount of those rounds might differ depending on where you are in the country, who you're talking to, what industry you're in. So this is all just to um, generalize a few ways to look at the venture landscape and the equity investing landscape. So um, typically you're going to be starting with a raise that's either pre-seed or seed, meaning you're still early stage. Who you're going to in terms of your investors is going to vary a little bit. It's going to be a lot of those that Evan talked about in the beginning as types of equity investors. You might start with your family and friends and fools, as well as founder investment. Founder investment will be coming in at that earliest stage, or being sought at that earliest stage. Um, you know, what what stage your company is actually at, whether you're pre-product or you have just really early product, that's not going to dictate necessarily whether you are pre-seed or seed, but you're still in that ultimately an early stage investment. And similarly, exactly what you spend that money on is not going to dictate that, oh, you're this versus this. But use this chart to generally get a sense of the progression throughout VC, because VC is you know is really um, a progression. You are taking money often at multiple points in your company's growth to fund different types of needs. At the same time, who you're going to at those different stages is going to vary, and that's the biggest takeaway from this chart, is that you should really be thinking about all of this and how your company fits into into a strategy of any particular investor. And so with venture capital investors, we're often going to tell you we will invest in these stages with these check sizes. So that's one way to help triangulate where you should go. And you can also seek advice from us, from the Tulane Innovation Institute, from any other support organizations who are there to help guide you through this.
Patrick, before we move over into talking about when venture is not a good fit, or there might be some mismatches, I do see a question in the chat from Craig. And why does a fund have a limited life? My quick thought, and Patrick, if you have anything to add on, it's sort of twofold. Well, one, it is stipulated in our limited partner agreement that we have a 10-year term on our fund. We also have the option to extend it for 2 additional 1-year periods, but it is quite literally in our fund organizing documents. At the same time, investors want to get their return back. And so at the end of the day, anything that is over a 10-year time horizon, I mean, that's a long period of time, right? So investors want to know that they're going to be able to get their return.
Yeah, there are different types of fund models that could accommodate to not have that life. You could have an evergreen fund, but most capital firms that are taking limited partner investments are, for the reasons Evan described, going to opt for the closed fund model. All right. So when is venture not the right fit for your business? Um, a lot of this is going to quite literally look like just the opposite, but we wanted to provide some opportunities to give very specific examples and help relate it to businesses that you might be thinking about growing or starting, and to make sure that that we're addressing everything. So first, service-based businesses with limited scalability are not going to be a good fit. Think about this as your professional services, your accounting, or your legal. That's because for every service or every extra dollar that's brought in on the revenue side, there's someone behind that often, really um, putting in the work, and therefore creating the expense that's associated with that extra dollar of revenue. That's not to say that no startup in the accounting or legal field could be a good fit for venture. All it's saying is if you are pursuing that, it shouldn't be a straight service business. Maybe you are somehow incorporating a technology or AI that is allowing you to increase your revenue without increasing those expenses. But on purely service-based businesses, where scalability completely corresponds to increased headcount, it's not going to be a good fit. The second one is brick and mortar consumer-facing businesses. So think restaurants or retail that are really strictly brick and mortar. It's because being anchored to a physical location in order to deliver any products or services will ultimately limit your ability to scale. And then finally, if your business is cash flow positive, you might not want to take venture money. There are plenty of examples where cash flow positive businesses have taken venture money because they have a much larger vision, and the only way to get there is to take on outside investment. But if your cash flow is able to support your goals, then there really isn't a need for you to take on venture investment because it's expensive. You are quite literally giving up part of your company, and so it's something to consider whether it's ultimately right for you.
I would also just add one quick caveat on the sort of brick and mortar side of things. There are certain uh, times when like quick service restaurants, for instance, fast restaurant chains. So there are instances where perhaps that model does fit, but just generally speaking, wanted to if you're opening up a single restaurant or brick and mortar retail space, then that's not scalable.
Yeah, that's a great point, Evan, and it's also a good distinction between different types of equity investors and what stages. So really right now because we're focused on venture capital, we're excluding those growth equity, those private equity investors. They're going to have completely different profiles that they're looking for. And in that case, a brick and mortar, if they can roll up enough of them into one company, that might make sense. But in terms of seeking multiple venture investors to go into a deal because you're expecting a 10x, 20x return, brick and mortar is going to be a lot more difficult. A few other mismatches include smaller niche markets with limited growth potential. So this is going back to that one of those first slides around addressable market. It's not to say that business can't be successful or profitable in a smaller niche market, but ultimately the question remains, is there enough room to scale to get to that really large return? Could be cash flowing great, and it could be for you personally a good investment, but it just doesn't fit the venture capital model. Timing not aligning. Going back to our question in the chat about why do funds have terms? It's because our investors need to be able to get their money back. It also really can, if you know that your business is going to have a really long runway, maybe you are in life sciences, approaching a venture fund that is strictly investing out of a fund that's towards the end of its life, that might not be a good fit. Maybe you keep in touch with them and wait until they're deploying their next fund and be one of their first investments. That would give you a lot longer of a runway within that fund. And ultimately, the amount of capital needed for your business, it's something that's really important to understand before you begin any conversation. You don't necessarily have to have a fully fleshed answer, but you should be able um, to identify how much and what you're going to use it for generally. And if you're not seeking a lot of money, then it's probably not a good fit because venture capital funds often are going to have minimum check sizes. So if you're looking for $5,000, um, there's a you're probably not a good fit if that's all you're looking for, and that's because um, in order to be efficient, we have to look at how many investments can we manage within our portfolio. How can how can we still be effective? Because ultimately that's our responsibility to our own investors. And so seeking too small of an investment just doesn't often make sense. That might be more for a friends and family or an angel investor who is willing to write that small check.
I would also say the same is true on the flip side of that too. If your capital needs are too much, it might not be right for venture. If you need to raise $200 million to build a steel plant, um, and you're looking for venture funding, that there might be a mismatch there as well.
It doesn't mean you can't get money though. So to wrap things up, we're gonna quickly touch on a few other types of capital. And Evan did explain the difference between debt and equity at the beginning of the slide. We wanted to make sure that we were giving you some things to pursue in terms of debt and other types of capital, so that we're not just leaving you with this isn't right for you, in the case that it isn't. So with debt, there are a couple things to think of whenever you're first approaching that. The first is, what stage is your business at? Similar to venture, but it will be bifurcated in a different way. Really, you need to think about whether you are a pure startup, whether you have less than 2 years in business, because that's going to mean you need a different lender profile than if you are a little bit more established, you have positive cash flow, then you might be able to go a more traditional route. So be sure to think about that. Um, Understand programs that are intended to help your business. So SBA lenders, that's something that a lot of people have heard of. The SBA loans, those outside of disaster recovery loans actually come from financial institutions. They don't come directly from the SBA. They're called SBA loans because the SBA partners with those institutions to guarantee it and allow that bank or credit union or whatever lender, whatever type of lender it might be, um, it helps to de-risk it a little bit for them. So you can certainly find institutions that are doing SBA loans, but you should really be going to your local lenders rather than the SBA directly. And the SBA's website will actually direct you back to them. Just something to note. And secondly, CDFIs, especially locally, we have a large number of community development financial institutions. Their intention is to get money, to get capital to people who have otherwise challenging situations in getting it. It can be a number of factors, and this is not a one size fits all across CDFIs in the region. They all still have their own standards, but they have a bit more of a layer of community mission to what they're doing. Um, Whenever you're thinking about potentially pursuing a loan, be sure that you understand the difference between a term loan and a line of credit. They're used for different purposes. They are also structured differently, so your repayment is going to look different for each. So be sure you're paying attention to that and know that before you approach a lender. And finally, if you do have further questions about debt and want help pursuing that, I recommend going to Propeller. They are part of the Financial Wellness Collaborative with a few other organizations locally, and they have tremendous resources in actually pursuing this. you want to go?
Oh, so other briefly, a couple of other types of capital that are music to investors' ear when we see that you have non-dilutive funding or grant opportunities, so that is not diluting the amount of equity that you are having to or ownership that you're having to give up. Government grant programs, just briefly, SBIR, STTR, Small Business Innovation Research, and Small Business Tech Transfer. These are funds that would be available to you. I would highly encourage you to reach out to our friends at the Innovation Institute who can help you with navigating that, as well as small business grants. Hello Alice, Entrepreneur Support Organization newsletters as well. Problem is that they're just not necessarily predictable or really abundant, but they are out there. Lastly, crowdfunding made popular by companies like Kickstarter or GoFundMe. There are debt crowdfunding applications as well. Kiva is a very popular one, as well as Honeycomb. And then more recently, we've been seeing equity crowdfunding. WeFunder is a popular one. In fact, I recently came across a company on WeFunder that was a Donna's Pickle Beer. So it's a very interesting case, but these types of programs are out there as well, outside of just venture funding. And then
I'll
finally,
add,
go ahead.
sorry, I'll add on crowdfunding. It can seem very attractive because it can, approaching people for smaller amounts of money can feel less daunting. Just be very aware that crowdfunding is a grind, even more so than venture obtaining venture funding in some ways. It requires a ton of marketing, and also certain types of businesses that do have consumer appeal are typically likely to do better because people can get excited about them. So just something to keep in mind.
And one last thing there, I would also just caution specifically on equity crowdfunding. Make sure that you're a little more well-versed as it relates to some of the securities regulations out there. You don't want to get yourself into trouble for any type of general solicitation for your crowdfunding needs. So just something to caution and be aware of. And wrap up, if you'd be interested in applying for investment from 1834 Ventures, a couple of things to note: go to our website, 1834.vc. Take a look at our diligence process, which is outlined there. And then there's also a link for you to be able to apply for funding. Lastly, the part 2 of venture funding basics that will be led by Marco Nelson at Tulane Ventures will be Wednesday, September 10th at 11 a.m. Central. Make sure you register. And then we're going to go ahead and take some questions now. So before that, because what I'd like to do is take my screen share off. I know that there's a couple of other dates that we wanted to make sure to mention to you. So that the Innovation Institute programming has in August, September as well. And so, Jalen, did you want to add anything to that before I take myself off the stop share?
Just thank you very much for joining us for this webinar. Please keep an eye out for us and our future events. For those of you who are currently at Tulane watching this, our Provost Proof of Concept Fund applications are open. As Evan just said, on September 10th, we're going to have the follow-up to this call with one of our very own, Marco Melero, talking about venture funding basics. And then please join us if you are in the New Orleans region for our Innovator Happy Hour on September 23rd from 5 to 7 p.m. at the New Society. So hope to see you there.
Thanks, Jalen.